IAS 20 is the standard dealing with common grants. So we can get grants for the expenses the entity incurs, or we can get grants for the assets we purchase. So depends on company policy, what is the, even the government's policy, what they want to promote. So depending on their promotional activities, they may give grants related to income and grants related to assets. So when I say grants related to income, means there is some expenditure incurred for which we get grant. And we are eligible to record this grant only when we become eligible for it, or we believe that it is going to be receivable since we have met all the conditions to be able to receive that grant. Grants related to income, we have a choice that we have incurred some expense of 100,000. If there is a grant of 30,000 for it, we can reduce that expense from that, we can reduce the grant amount from that expense and can record net expense of only 70,000 in the books. This is one way of doing it. The other way of doing it is, or we continue to record the expense at 100,000 and record grant income of 30,000 in the books. The other way is we show it separately as income. So this is how we deal with grants related to income, either reduce directly from the expense or either show it separately as other income. This is shown as other income, the grant amount received. For grants related to assets, again we have a choice. Either deduct directly from the cost of asset, or use deferred income approach. What is the difference between the two? Suppose we bought a machine for 100,000. Useful life is 5 years. We deduct the value of the machine. Normal depreciation would have been 20,000, but we say that machine 100,000, reduce grant amount received 40,000 and record the machine at 60,000. Depreciation on it will be 12,000 per year. Normal depreciation would have been 20,000. But this is not allowing us to track the depreciation. So some accountants were of the opinion that this is not a fairer presentation. We should use deferred income approach. Deferred income approach says that continue to record the asset at its value and charge normal depreciation. But on the liability side, create an account known as deferred income. 40,000. And at the end of each year, on the basis of systematic allocation of asset, transfer the amount from deferred income balance to P&L at the end of each year. So systematic allocation is 20,000 per year. that we are going to spread this cost of 1 lakh over a period of 5 years, 20,000 each year. The cost is 20,000 for P&L. We can reduce the same cost by transferring this deferred income also on systematic allocation basis, that 40,000 divided by 5 gives me 8,000. So we transfer at the end of each year 8,000 to P&L, deferred income debit 8,000, credit P&L account 8,000 for the grant amount. What is the impact of it? We are charging depreciation of 20,000 to P&L. P&L is being charged depreciation of 20,000, but it is being credited by 8,000. The net impact is, how much is the net impact? 12,000. Automatically, the net impact in the P&L is 20,000 minus 8,000, 12,000, which is happening directly in this case. That we were charging only 12,000 depreciation per year. When we directly reduce the asset value by 40,000, the machine value was shown at 60. But this is not helping us to know what was the real value of the asset and what was the actual depreciation which was charged. So deferred income approach is being used in India. We'll be using only this approach in India. We'll not be allowing the second approach. And as far as IS-20 is concerned, we have choice. We have a choice that we can directly reduce the value of the asset, or we can use deferred income approach. Is this clear? Any questions? So grants related to income, two choices: directly reduce the value of the expense, show other income. Grants related to asset, two choices: reduce the value of the asset or create a deferred income balance and use deferred income approach. Any doubts, any questions on this? Any doubt, any question? So look at the objective, scope, recognition criteria, and how is government assistance different from grant. So we account for the transfer of resources from government to facilitate comparison of an entity's financial statements with prior periods and other entities. If there is a grant received, definitely the results will differ. Accounting for and disclosure of government grants is and government assistance is governed by IS-20 government grants. Government here can be government agencies, government bodies, local, national not necessarily the ruling government. Government assistance is in the form of transfer of resources to an entity in return for past or future compliance with certain conditions leading to operating activities. So if they met with all the conditions which make them eligible to receive the grant, the entity can record grant receivable in their books. If not, and if it is unconditional, they do not have to return it, they can show it as income directly. It has to be qualifying asset which the entity has purchased, constructed, or otherwise acquired. It can be related to assets, it can be related to income, means they are incurring an expenditure which is eligible for grant, or they are incurring a capital expenditure which is eligible for grant. So capital or revenue expenditure directly into P&L, capital expenditure dealt with grants related to assets. So there has to be reasonable assurance that the entity will comply with all the conditions attached to the grant and grants will be received. If yes, we can record a government grant. If not, we will not be recognizing any government grant, even eligible for receiving or receivable, until it is sure. So two choices: grants related to assets. Either set up a deferred income, as I said, on the liability side, create a deferred income. Income is recognized on a systematic and rational basis of economic life. The systematic and rational basis for 5 years was useful life. So we also spread this 40,000 over a period of 5 years in the form of 8,000 per year. The second option is deduct grant in arriving at carrying amount. 100,000 was the value. Reduce 40,000 grant. Record 60,000. Income is recognized over useful life by way of a reduced depreciation charge. The depreciation charge would have been 20,000, but since we reduced the value of the asset by 40, the asset value remained 60. 60 charged over a period of 5 years turned out to be 12,000 depreciation charge every year. So you have a choice. You can use one of them way. Is this clear? Translate to income credit separately as other income or deduct in reporting that expense directly. Repayment of government grant. What if you have to repay? If we repay, depending on what method you followed earlier. If you followed this method earlier, then you will have some deferred income balance. We'll have to reverse this deferred income balance because your asset side is normal. Normal depreciation, normal value. What is there which is to be rectified? It is your deferred income balance which is to be rectified, which is to be reversed. But if you have been following this approach, you reduce directly, then for each year for which you have charged reduced depreciation, you need to charge additional depreciation now. Because you are supposed to charge 20,000 depreciation, but you have charged only 12,000 depreciation, you need to charge this additional depreciation because you are required to repay this money now. So depending on which method you followed, will your accounting for repayment will follow. So increase carrying amount of asset or reduce deferred income balance. Increase carrying amount of asset if you use the first approach. That if you reduce the value of the asset directly, then you need to increase the value of the asset. But if you did not reduce the value of the asset, you created a balance known as deferred income, then we need to reduce that deferred income balance, whatever is remaining in that balance. Recognize cumulative additional depreciation immediately as an expense. When you reduce the value of an asset directly, you charge reduced depreciation in the form of 12,000 per year. Now you need to charge additional depreciation for all the years which have passed till date. 8,000 depreciation has to be recorded. Suppose 2 years have passed, so 16,000 additional depreciation will be recorded this year. For related to income, if there is a repayment, apply a first against any unamortized deferred credit. If there is any balance which is shown as other income, which you will have to reduce it or recognize any excess immediately as an expense. For related to income, we have only two choices. Either it is shown separately, this will go away from the books, or if it has reduced my expense, I'll have to charge that expense again. How is government assistance different from government grant? Government assistance do not have any value which we can record. So government grants has a value which we receive, which can be recorded in the books. Government assistance doesn't have any value which could be recorded on the face of the balance sheet. So we disclose in the notes to accounts that we got this support from the government officer who guided us on some technical. So there is a farmer who gets the guidance from a government agriculture officer who guides on what to produce, what not to produce, what spray to be used. If there is some assistance being provided by the government in the form of knowledge transfer, there is no value which we can record, but it is being supported through government initiatives. So this can be disclosed in the notes to accounts if an entity gets these kind of assistance for a commercial rearing or for commercial plantation. So government assistance is action by government designed to provide an economic benefit specific to entities qualifying under certain criteria. If they meet the criteria, they get assistance. Reason for exclusion cannot reasonably have a value, cannot be distinguished from normal trading transactions. So significance of benefits may be such that disclosure of nature, extent and duration of assistance is necessary in order that financial statements may not be misleading. At least the shareholders should know that this entity is eligible for getting these assistance and these assistance are helping them to generate economic benefits, though directly not valuable in monetary terms, but indirectly beneficial, so disclosed in notes to accounts. So disclose the government grant policy adopted, whether direct, whether indirect, whether creating a deferred income approach, the nature and extent of government grants recognized. If there is any repayment done, we need to disclose those repayment of grant loans. Any unfulfilled conditions which we have not met and because of which repayment has been done, or any contingencies which has been attached to these government grants or assistance, we need to disclose in the notes to accounts. This is all for government grants.